Welcome back to CMB Connect, where we go behind the designation. I'm your host, Val Buresh, and today we are doing something a little bit different. We are going to step into a time machine and journey through the last 4 decades of the mortgage industry. And our guide on this trip is someone many of you know, Mike Hyman. From the days of manual originations in the early 80s to the birth of the private secondary market, to the dawn of reverse mortgages, and even the rise of offshoring, Mike's career is a living biography of our industry. He also happens to be celebrating 30 years as a CMB this month, October 2025. Mike, it's an honor to have you. Thanks for joining us today.
My pleasure, Val. Thank you very much for having me. I appreciate it. As you said, 30 years of the CMB is kind of hard to believe. Here's a class of 1995 in San Diego, 30 years ago, October. So it's definitely something to celebrate.
This is a wonderful picture. Please leave it for a moment like this, because I want you to take us back to 1982 and paint a picture of the mortgage industry that you stepped into 43 years ago.
I'd be glad to. Yeah, the 1982, if you think about it, was only maybe 10 years or so since the creation of Freddie Mac, the Equal Credit Opportunity Act, the Community Reinvestment Act. In fact, it had only been maybe 7 years earlier when married women could get a loan without their husband's approval. So there had been massive changes in just the previous few years, and mortgages could include restrictions however you wanted on who you actually sold the house to. Put that in perspective of incredibly high interest rates and inflation, and you get an idea of a very difficult time to start in that business. In fact, we had the beginning of the securitizations at that time as well. And this is, I thought you'd get a kick out of this. This is an article from the New York Times in January 1982.
Wow.
And it shows that the interest rate that week of the 16th was 17.44%.
17.44%. Wow. And we are complaining about 6.5%.
Yeah, I don't feel that sorry when I sort of feel like, okay, when people complain 6.5%, 7% is really high. I like to point out this was where we were selling. The first rate sheet that I carried with me when I started had a 17% 30-year fixed rate mortgage. Just as a point of interest, the highest the interest rates ever went for a 30-year fixed rate was over 18%. But it was quite something to start in that environment. In fact, even years later, we talk about high interest rates. This is from March of 1991. One of my CMB colleagues, Bronwyn Morrissey, was unpacking a box and found some newspaper it balled up that she'd used to wrap up something and posted this. And it showed how interest rates had fallen as low as 12.75% by that point. But at the same time, you could buy a house in suburban Chicago for $69,900.
Wow.
So that was really something. But we had, in fact, there were other products that were introduced at that time to try to do something about the interest rate. ARM loans were brand new. We saw the introduction of adjustable rate mortgages for the first time as a way to say to customers, if you'll share some of the risk of interest rate movement, we can give you a much lower rate. We also saw experimentation. We kind of know how it ended up with negative amortization loans at that time, which we all believed that housing values always went up. So what's the worst that could happen?
Yeah.
And so you even had Fannie Mae had a plan called 6A, which was a GPARM, graduated payment adjustable rate mortgage, which had to charge the interest rate here and gave the borrower payment amount here. And it was supposed to be made up over 5 years by slowly increasing payments. And clearly it didn't work out that way. In that early 1980s, you also, but you still, again, Fannie Mae and Freddie Mac were there through all that time, but everything was incredibly manual. Well, first thing, again, no internet, obviously, no web-based applications, didn't have automated underwriting yet. What you did have is you'd find borrowers through some of the same ways you do now, through relationships with builders, developers, former customers, other relationships. You might have a state housing agency program, a bond program that lenders would be allowed to offer at a lower rate, say for first-time homeowners. And you'd get your long form 1003, the old one, which was a legal size document, fill it out by hand, and then all of the processing was done manually by sending out confirmations. The interest rates were set by your secondary marketing department, typically once a day, and somewhere mid-morning. So what that meant was that if you worked over the weekend, you had until about 10 o'clock Monday morning to lock your rates in at Friday's rate. So even with all the movement, you had that at least as somewhat of an advantage. But it was all done with paper manually. Then the processor would set the loan file up in this hard-shelled cardboard loan file with card dividers in them that had all the different pieces in there, the appraisal, credit report, verifications, which were all paper-based. You wanted to verify someone's income, you had to mail a request to their employer and get it back through the mail.
Mail. So that would take 3-4 days. One way, 3-4 days back.
Yeah, that could take several days to get that back. Same thing for verification of employment. This is all done that way.
Yeah.
And once completed, the file would then be hand delivered. We use the word handoff now, but that term came from, it was literally, I would hand you, the underwriter, a loan file and say, this is now ready for underwriting. And you would go through and look at every single page.
So the technology was paper, pen, or maybe typewriter machine?
And typewriters, right.
And a postage stamp for delivery of documents.
That's correct. You're always careful. You didn't want to let somebody have it hand delivered. You wanted to be sure it came through the mail to avoid any fraud situations. And underwriters at the time, for example, would look at the verification to see if it had any creases in the paper to make sure it had actually been put in an envelope. If it didn't, they might question it. So all these little tricks that went back into making sure that loan files were properly documented.
Yeah. So the way that the mortgages were designed and manufactured without the tools that we have today, it was very manual. But is the process the same as it is today for designing and manufacturing, but with different tools?
Yeah, design really comes up with, as you would expect, what does it take to develop a product that customers will want to buy, that investors will need? The issue was, once you identified a potential customer, how did you qualify that customer? Now, without any technology, what did you do? Well, we loan officers would carry one of these. This is one of these qualifier plus 3FXs that you would use to figure out the PI, TI. This is a commercial version, which also does cash flow analysis and IRR. That it's little things like this that you would take with you, and you could speak to the customer and explain, here's what we think that you'll qualify for, because underwriting ratios were actually 28-36 for the most part for conventional conforming loans, and with some ability to tweak that a bit, not the 45-50% that AUS allows today. Then it was pretty straightforward to say, here's your income, here's what you can afford, and then to proceed from there.
How big was a loan file? How many pages did it have?
It would be pretty thick for a salary borrower. Obviously for a self-employed borrower, it would be significantly bigger.
Wow. So a lot of weight and a lot of paper. You had to make sure that every page is in that file. Part of the reason that and we'll talk about that a little bit later, but part of the reason we went to no documentation, no verification later on is because we were coming out of this very much manual process where you had to keep track of all these pages and documents, and people innovated and said, let's get rid of this.
It actually, two factors converged from different directions. One was the desire to to ease the process, to make the process easier. The other thing was over time, we started getting better and better data on how these mortgages were performing. So you started saying, okay, a customer with these characteristics, most of the time, this loan is going to do just fine. We really don't need to go through all the steps we did before, because for the vast majority of these, they're going to perform well regardless of how much underwriting we do. And at the time, that seemed to make sense. With the ability of retroactive perspective, we obviously, in our industry, we constantly are saying, what were we thinking back then?
Well, just rounding your background here, the beginning of your career, you have a degree in radio, TV, and motion pictures. And I wanted to ask you, how did you end up in mortgages? And did that communications background give you a unique edge as a loan originator, or maybe it was not helpful at all?
Well, first, I was sure I wanted to become a radio reporter. That was my goal, was to be a broadcast journalist. And that's where the degree started. But I also had an interest in real estate, and then moved more into finance. And you talk about skill sets, and I want to say this to everybody. Very, very, very few people have anything resembling a mortgage banking degree when they get out of college. And one thing I've learned as a school mortgage banking instructor, where I've had a chance to look up the backgrounds of the students that are in these classes, their experience comes from everywhere. A large number, in fact, from food services like servers and bartenders. And you wonder, somebody that's dealing with difficult customers there can do well here. Similarly, for me, the skill set I developed to put a microphone in your face and ask you some tough questions and get you to answer honestly, it's the same skill set to ask a borrower, prospective applicant, in a nice way, to ask them to explain their financial situation, even if it causes embarrassment.
So all these experiences, I think they're everything that we go through, the education that we have, we layer as we go through life and leverage as best as we can. And I tend to agree with you. I haven't seen anybody who has bachelor in mortgage banking. There is no such degree.
No, and it's one of the strengths of our industry is that we get people with such diverse backgrounds and experience. Because think about it, each of the different, if you think of what skill sets are necessary as an originator, as a processor, as an underwriter, as a closer, if you're sales oriented, you like the public, you like being out there, we have sales. If you are very rules based and you have a great ability to handle unstructured data, then processing. If you're an analyst and like making decisions, and you have underwriting. If you're a phenomenal, maniacal project manager, then there's closing. So there's all sorts of analyst and oversight roles. So regardless of what your background, if you're intrigued with the mortgage business, there is a place for you depending on whatever background you have.
Yeah, very well said. So back in time, the 80s, you entered the industry, and the 1980s are roaring, so to speak. They're progressing, and the entire mortgage market infrastructure is beginning to change. You are seeing now the entrance of private label securitizers, and you ended up in secondary marketing, right?
That is correct. I'm laughing because this is just before the private label securitization. Secondary marketing, and this, I started with a whole loan secondary marketing firm. It doesn't even exist now anymore, that whole function. But at that time, loans other than those sold to Fannie Mae and Freddie Mac were sold on a whole loan basis, particularly ARM loans and others. And what would happen is someone would have a commitment they needed to fill. They didn't have enough loans. They need to buy some loans from another lender, or a lender had extra loans left over they wanted to get rid of. They needed a buyer to buy those. There was no automated or online platform to do that. So whole loan brokers, like what I did, was we had clients, both buyers and sellers, and we would match them up. And it was all done on a handshake over the phone. So you'd call me and you'd say, I've got $300,000 of 12.5% ARM loans that I have left over from my last commitment. And I'd say, hold on, I'd call a buyer and say, I've got this at this price. Are you interested? Yes. Buy, sell, commit, done. And we would get a commission for the sale. So that's how things were done for a long time. So the MI companies started picking that up. And then when the securitization started, this whole SOL loan started going away. But it was at that time also that I got started going to MBA conferences and other secondary market conferences. And if I can, I wanted to say a word about what that actually
Yes,
entailed.
I'm intrigued.
Well, in the first place, there were a lot of organizations that were offering secondary market conferences back then. You had the U.S. Savings and Loan League. You had the Eastern Secondary Conference, which was always in Raleigh. And you had the Western Secondary Conference, which it still exists in A form, but it used to be back then, it was always at the St. Francis Hotel in San Francisco on Union Square. Then you had the MBA Secondary Market Conference, which wasn't planted in New York yet. It would move around to different places. And you had people sellers of loans who would bring a cardboard box full of loan files and to show prospective buyers what their loans looked like so they could assess the quality and make a decision as to whether they wanted to buy loans from that particular source.
Wait. Just a second. So they brought the boards, the boxes into the conference?
Yeah. They brought them into the conference and someone would go over in a corner and they would look through some of the loan files. These look good. Yeah, we'll take. And this is how some deals were done back then.
It's so hard to imagine that from today's perspective that this actually happened.
It did. And one thing I think you'll get a kick out of, I have some pictures from some of the secondary market conferences I attended back in the 1980s. And other conferences, if you look starting in the upper left-hand corner, that's the Eastern Secondary Conference in Raleigh in September 1985. Yeah, just a bunch of papers out on a table. And moving to the right, you have the MBA Secondary Conference in Chicago in April of 1986. In the middle there at the top, the Western Secondary Conference, again, a table with a tiny little monitor low on top. Then moving on, you have the at the bottom right-hand corner, that's the U.S. Savings and Loan League Secondary Market Conference in New Orleans in 1986. And look at that. Over on the right, you'll see a portable computer, not a laptop. If you put that on your lap, you'd break a few bones. It was so heavy. And I traveled with that on a plane, and it was heavier than my luggage. And you'd hook it up to a little TV monitor just so people could see what was on the screen. And all it was just maybe some rates and some basic information, just text. There wasn't a whole lot more you could say. Lower left-hand corner, that's the MBA convention in 1986. Again, just a lot of papers, early computer, and this is the exhibit area, exhibit hall. And so we were vendors and our potential buyers and sellers would stop off and we'd talk about what products and things we had available. And in terms of a work environment, you think for those of you working from home or you have a very high-tech oriented office, imagine your clean desk at your office. Well, this is what it looked like working back in the mid-1980s. Without the technology, you had all the papers on the wall that were the various lenders and what they were looking for, buying and selling loans. Wow. And that black thing just to the left of the picture, that is a Rolodex. Ask your grandparents about that. And so how I kept track of my clients, and everything, again, you asked earlier about the files being manual.
Yeah.
This is a file room. This is a promotional video we made from the company I was working for then. This is actually in the early 1990s, but it just shows how it's all paper. These are loan files. And yes, that is how women dressed back then at the office. But it's all manual loan files. If you wanted to pull up some information or you wanted to see a loan document, somebody had to actually go into the file room, find the loan file, and check it out.
Yeah, that's incredible. This is really so powerful to see the photos as you were telling the story, to see what actually it was, because you can't imagine from our perspective today, many listeners were probably not even born at that time in the 80s.
That is true. But again, there were a lot of those conferences, a lot of that all went away later on. And It would take a minute, actually. I want to talk about Fannie Mae and Freddie Mac in the
Yeah.
late 1980s and the early 1990s.
Yeah.
Most of you out there, if you've come of age in this industry after 2008, know them as government controlled buyers and securitizers and guarantors of mortgages. Nothing very sexy or exciting. Well, Fannie Mae was very different back in the 1980s and early 90s. The industry was nearly totally dependent on Fannie Mae and Freddie Mac for innovation. There was just very little innovation beyond what the two companies did. And between the two of them, they would come up with automated underwriting. As the time I was with EDS, and we actually developed the technology behind what was then called Loan Prospector. And then Fannie Mae followed very quickly with DU. And
Mm-hmm.
that was record-breaking, headline-grabbing. Oh my gosh, there are not going to be any more human underwriters. And of course, that's not what actually happened. It just meant underwriters could spend more time on loan files that needed the human intervention, and companies could therefore close a lot more business. But most of the effort, as Fannie Mae would expand into other areas of support, it was always with the tagline, well, if it encourages home ownership and lowers the cost of getting a mortgage, it was a good thing, regardless of what it actually was that we're talking about. The cultures were also very different. Anyone who ever went to Fannie Mae or Freddie Mac's office back then knew that Fannie Mae was the inside the beltway, very formal. You had to wear a tie, a suit, when you went to their office. Their leadership was right out of, remember, again, this is right out of the government. Franklin Raines, Clinton's OMB director, became president of Fannie Mae. So it was very politically oriented, I would say, whereas Freddie Mac over in McLean was laid back. You would dress sort of like how I'm dressed now, that is the dressiest you would get. And you had a lot more flexibility beyond that. You wouldn't dare show up at the Freddie Mac office wearing a tie. And so there was a lot of culture. Although on the other hand, the MBA secondary market conferences back then, Freddie Mac and Fannie Mae had huge areas, exhibit hall areas or meeting rooms. So you would go meet your customer rep, talk about various programs, and the rooms would have lots of meetings going on at the same time. And then for entertainment, Freddie Mac would be the more sedate. They would sponsor, say, a reception or wine and cheese reception at a museum. I just always remember it being a very nice, quiet, easy to get along, while Fannie Mae sponsored, I'm not kidding, the rock and roll party. And for years at the secondary conference, Fannie Mae would sponsor a rock and roll party. It would be a big secret who was performing, because it would be big name groups. Well, big name for back then, like
give us
Kool and the
example.
Gang, Kool and the Gang, and the Four Tops and Temptations and others, decent groups. And I don't know, Val, it put in your mind the image of a bunch of aging mortgage bankers getting down to 1970s music. I'll just tell you, I'm so glad they didn't have phones with cameras and video cameras back then.
That's right. That's right. Well, so Fannie Mae was on Wisconsin Avenue, right? In DC all the time. So fun fact, I'm behind that building. My office is behind that building right now. Yeah.
That's great.
So can you clarify or fill my gaps there? How much did Fannie Mae and Freddie Mac influence the mortgage banking industry? Is it in the same way that they do now? I mean, it's 60, 70% of mortgages are sold to those two agencies.
There were fewer products perhaps available at the time. The influence I always felt went beyond market share to actual, as you said, innovation. Everyone looked to Fannie Mae, Freddie Mac to improve the business. I wouldn't say it was a great thing, because I think it was much later. It took fintech companies and it took software developers to really change our industry and bring in things like web-based and app-based applications. I think, was it Rocket's predecessor?
Quicken.
Quicken, that had the first fully web-enabled loan application. And so that was a difference. We would move pretty much all in the same direction. It didn't look anything like it did now. And while Fannie Mae and Freddie Mac still serve a vital function, then we're going to be hearing a lot more of that in the future. You saw today's Wall Street Journal top story was this potential IPO
Yep.
for Fannie Mae and Freddie Mac.
Yeah.
Very different from back in the day when the real intent was to help bring innovation, to help bring programs to help low to moderate income borrowers and provide financing. By the way, another fun fact, the current conforming loan amount for high cost areas is now over $1 million.
Oh, yeah.
In 1982, the conforming loan amount was $107,000. And that was for the lower 48 states, 50% higher for Alaska and Hawaii.
Yeah. Yeah. That's 10 times more now. Yeah.
Yeah, exactly. You can see how things have changed quite a bit since then.
Absolutely. Yeah. Speaking of innovation, let's go back to the 1990s, and stay there for a while. You saw the birth of subservicing. So can you talk a little bit about what was the core problem that this new innovative solution at that time was solving? And has it changed since then?
In the late 1980s, many loans, if not most, were done by savings and loans. And these institutions had already had a rough time in the 80s because of all those mortgages, long-term fixed rate mortgages they put on their portfolio that they didn't sell. And their cost of funds started going way up. When you have a 12%, you have to pay 12% for a CD, and you've got a whole bunch of 6-7% mortgages in your portfolio, it's not going to end well. And so subservicing started as a need for these institutions to cut costs in managing their customers, and they wanted to put their focus on originating loans. And because the standards and the processes were so rules-based, and much of the industry, you remember the old CPI system, which then became Alltel and continued to evolve, most lenders were on that system. So as a subservicer, we're on that system. It made it easier to transfer loans in and to be able to manage them. And so as a subservicer, we would take care of the basic activities of servicing, customer service, investor reporting, escrow management, collections, foreclosure, all of those aspects that are a part of a servicer's responsibility, but at a fixed cost to enable them to put their focus on other things. And that way, if they decided to sell their servicing portfolio, it made it easier because it was already being managed elsewhere. But it was a small-time business until the collapse of the savings and loan industry and the creation of the RTC. When that happened, the few of us, and it was Wendover Financial, that was the company I was with then, Linton Mortgage, Dove and Mule, there were several early adopters in the subservicing business. Standard Fed, who is interesting, was a savings and loan that got taken over, but continued to do subservicing. But this overnight, the Resolution Trust Corporation was saddled with thousands and thousands and tens of thousands of mortgages from failed institutions that needed to be managed. And once again, a credit to our industry to come up with a solution to help deal with an interim crisis of this time. We had 18-wheelers backing up to our office, dumping boxes of loan files. But remember, we always said for everyone loading files into boxes, it was their last day at that bank. So the quality of the quality of the files we got was terrible. But very quickly, we had to scale up fast. We had to learn how to do master servicing when the RTC found that many California savings and loans were only buying 90% of the mortgages that they purchased, leaving 10% and the actual servicing rights with the originator. And so handling those LSBOs, loans serviced by others, required a whole different skill set that didn't exist in a subservicing arena. And so those of us that had those RTC contracts had to very quickly ramp up and learn how to deal with that. The other, I know it sounds strange, but the other good thing to come out of that time was the create the context for standardization of the commercial mortgage-backed securities. And no matter where you are today, you can draw a line that goes all the way back to the early 1990s, mid 1990s, when the RTC, with all these distressed assets, had to figure out a way to dispose of them, and found through securitization a much more efficient way to do that.
Yeah. What happened to RTC? Remind me.
Well, it wrapped up. Right. The RTC was set up as, as part of the effort to deal with all those failed savings and loans. And it put itself out of business when it had disposed of enough of the assets that it could then go back to the regulators who were handling that work at that time. And so things kind of quieted down as you got into the latter part of the 1990s. Well, the other thing that impressed me about a lot of the RTC people I worked with is that many of them were actually from the industry. These were not people that, say, had been FDIC examiners that got thrown into mortgages. Because of the need to staff up so quickly, the government decided to actually tap in people from the industry. And so many of those I worked with already knew mortgage, and it made it at least a little less onerous to deal with that.
That made a lot of sense, to get the experts to work on something so high risk, high impact project.
So that was the dawn of subservicing, and subservicing continued to grow, and it continues today to be a valid option. Even now with offshoring and other options, it's still a very valid way for lenders to choose, what processes do they want to excel at, what do they want to do in-house, and how to manage their customers. And then, as we've talked before, at the same time, we saw the dawn of the reverse mortgage business.
Can you tell us a little bit more about that? I saw in your write-up that there was something called 50 loans for 50 lenders. Can you explain what this was and what was the initial reaction?
Involved in the FHA version of the reverse mortgages called the HECM, Home Equity Conversion Mortgage.
Yes.
Know it as it is pretty much today. But back in the late 1980s, when FHA came up with this program, you had to remember there was a legal issue. Many states did not have the laws to support reverse mortgages, because reverse mortgages, you may know, pay out over time.
Yes.
So if you have a payment a year after the loan is made to the customer, is that still protected by a first mortgage? Or if there was another mortgage in the interim, does that part of the payment stay subsequent to that one? So it took an act of Congress to create this product. And Congress created a demonstration program, is what it was called. And the initial part was they allowed 50 lenders to do 50 loans. And there was an initial meeting, and the leader, Jeff Taylor, one of my mentors, CMB sponsor as well, was at that meeting with his partner, Ken Austin, and they looked at around the room at the people that were going to be agreeing to do these loans and thought, there's nobody here that can service these loans. The current systems won't handle it. Somebody's got to design a system, and no one's going to do that for 50. So they walked around the room, handed out cards, and say, we can service these loans for you. And then ran back and actually built a rudimentary reverse mortgage servicing system. So at that time, in the early 1990s, Wendover Financial was the country's largest wholesaler and servicer of these FHA reverse mortgages, which were purchased by Fannie Mae. Fannie Mae is the investor, FHA the insurer. And by the way, we at this point, I think most people would agree reverse mortgages can make sense for some people, and for some people they don't. But the initial feedback on reverse mortgages was not positive. This is from 1996. This is one of the first Wall Street Journal articles about reverse mortgages. And I spent an hour on the phone with this reporter, and I got like one sentence in the article quoted just saying, I think these are a good option. And as you can see, the initial feeling was it was only as a last resort. It was incredibly expensive. And it took a while for the market to calm down a bit and for the public to accept, wait a minute, we've got half of the inquiries we're getting are from adult children. This is the first time you see a sandwich generation. taking care of their children and at the same time trying to allow their parents to stay in their own home.
Mm-hmm.
And so reverse mortgages, while they did have issues like not leaving enough money for payment of property taxes and insurance, that's been fixed. And there were other issues initially, have now become a lot more accepted. But back then, you can see the tone of an article like this was profoundly negative. And I found myself speaking at quite a few conferences, many about reverse mortgages, introducing it to people that had never heard of it before.
Yeah.
Because we had to create that market when it didn't exist. And you had some early adopters. Most of them were smaller lenders that got it. Norwest Mortgage, which became part of Wells Fargo, was actually a very big originator back at that time. At one point, they had 25% or so of the new production. And it was
Of what I see in the data, it's not a very big market by number. It's still very niche segment because, as you said, it makes sense for some people, but it doesn't make sense for the others. And maybe there is just a little bit more kind of a lingering stigma from that time. Perhaps people still are very suspicious about that product.
It should never be the only product somebody sees, and to make sure that reverse mortgages require counseling by a HUD-approved nonprofit counseling agency. So there are protections built in that you don't even have on most first mortgages to help ensure the customer is looking at other options. Maybe what do they need the money for? Maybe to repair a roof. Well, your state may have a roof repair for seniors fund that might be a better option. But the advantage for those that aren't familiar, a reverse mortgage, you don't make payments. You have to pay your taxes and insurance, have to live in the home, but as long as you do, you never pay the loan back. And then when you are no longer living in the home, if the house doesn't sell for enough to pay off the loan, the difference is forgiven. So there's no impact on the heirs.
What do you see was the key turning point that led to the growth in reverse mortgages? Because now we have more than 50 reverse mortgages in the market.
Two factors. One, I think, is a continuing collaboration among the lenders that did specialize in this product, a lot more a collaborative basis than you might have with other products. There were, and at the same time, improvements in the way the loan was structured to make it more acceptable to the public and not have issues like foreclosures because someone didn't pay their taxes or insurance. And then, on the other hand, the Ginnie Mae securitization was a major turning point, because that brought a lot of standardization and respectability. A lender who was interested in offering reverse mortgages that knew that they could put them into Ginnie Mae securities would be a lot more interested in the program than dealing, say, with a private investor.
So, Mike, at the turn of the millennium, the early 2000s, your career took an international turn. You went to work in the mortgage industry, but in a different country. So can you take us back to that time? How did it happen? Where did you go? Tell us about that time in your career.
Great. It was a monumental experience. In the early 2000s, a number of players in the U.S. mortgage industry were starting to look beyond the U.S., and there was a growing belief that what we were doing was exportable, and the idea of a secondary market built around a capital-based emphasis could work in other countries. And so the UK was one of the first to decide it wanted to start offering securitization and other potential areas. And then they partnered with American companies that could provide support. You had early adopters. Alltel partnered with Bradford and Bingley in the UK, Countrywide, yes, that Countrywide, with Woolwich was institution. And then the big one, the second largest mortgage lender in the UK, Abbey National, was interested in securitizing their very large portfolio, about 1.5 million mortgages. And so they hired EDS that I was working for before to provide that support. And I was given the opportunity to move to England to lead the group that was putting together what would become a joint venture between EDS and Abbey National and one of the largest third-party operations in the world. with in addition to the 1.5 million mortgages, 400,000 personal loans. They had about a 13% market share at the time. So it was pretty significant. The contract value, which is public, was over $390 million.
Wow.
So it was pretty massive. What was great is that I got to work with a great team of people. We were, put together a lot of the processes. We took over management of 1,500 staff from the bank, and proceeded then to look at building relationships not only with other lenders in the UK, but also moving forward into Europe, where there would be also a demand for this type of work. Now, to give you an idea of what things looked like back then, and while this all was going on, the experience of working in the UK was great. What you see here is my workspace in the upper left-hand corner. On the lower right-hand corner, this was an industry event. Now, they had their version of what we would call the MBA in the UK. It was called the Council of Mortgage Lenders. And the Council of Mortgage Lenders, as a British institution, their dinners were formal. So when imagine an MBA convention where at the evening event, you had to wear your tuxedo. So that was great. They had the toast to what was then the toast to the Queen. And there was a lot. I had to learn a whole new vocabulary, even though I speak English. It certainly wasn't the business English they used there. It was somewhat different. We had checking accounts. They called them current accounts. We refinanced loans. They called them remortgaging loans. And I mentioned that more than 2,000 distinct loan products. One of the reasons is because you could tie a mortgage to a checking account or tie it to a life insurance policy.
Really?
Or any number of different things that would make a secondary marketing executive's head explode if we tried to do that over here. Yeah, they were great. Think about the idea of a mortgage that paid and tied to a checking account. The checking account didn't earn any interest, but every month when the servicer went to charge interest on that mortgage, they would deduct from the principal balance what you had in your checking account.
Oh, wow. Yeah.
So if you had extra cash, you just park it in your checking account and it would bring down your mortgage amount. So it seems like such a simple thing, but of course, again, this is the American way of doing things, is consistent capital markets driven, consistent, and it would have been difficult. They have products that were offset mortgages, which would allow you to have multiple products tied into one. Oh, and their mortgages were portable. So you could have a mortgage that when you moved, you could take your old mortgage with you and just finance the balance if you needed to.
Mm-hmm.
That's
like
because
assumptions, like our assumptions.
Well, you wouldn't need to assume the loan. You just take it with you to your new property.
There's no involvement of the lender whatsoever.
Other than just change of address and potentially increasing the loan amount. Yeah. But if you think about it, England and Wales is like one big county. So you have His Majesty's Land Title Registry and all the loans there. It's as if the entire U.S. was one county. And so it would make it much easier. We can't do that here because the minute you cross a county line, it's another recording office.
Yes, exactly.
And so that wouldn't work there, but I found that as examples. And then if you go to the next slide, these are the top lenders. And you see the second one is Abbey National, which is the one we worked with. None of these names are going to be familiar to most American mortgage bankers, but these were the big mortgage players back then. And so as we mentioned at the time, U.S. companies were very active in supporting the market. You had really good operations like Tony Moss's Euro Catalyst, which became AmeriCatalyst later. The picture on the right is from an event in Madrid talking about the housing market and securitization. Mm-hmm. And so there were conferences in Lisbon and Barcelona and other places to start bringing the word to other lenders as to what was in fact possible. Yeah. And then, of course, you had 2005, where you had your previous guests that did the mortgage market in Egypt, for example. Yes. All of that was happening in the mid 2000s. Once 2008 hit, as you can imagine, the lenders in other countries were less interested in what Americans thought.
Yeah.
But I will
Yeah.
end this part by saying, Val, it was a lot of fun. If you go to the next picture, I had a chance to go to Royal Ascot, which is the most formal horse race with gambling you've ever seen. Men had to wear a morning suit with striped trousers, a top hat. Women had to wear hats. It was like playing dress up, but it was a lot of fun. And as I was walking around, I almost bumped into this lady on the right, who I understand was the owner of some of the horses in the race and had gone
Yes.
to check out her horses. I'm not sure, but I think she had another day job. And this was me taking the picture. I was that close to her. No security, nobody else,
Yeah.
just waves from the crowds and otherwise it was just the most natural thing in the world to see her walking out there. Yes, for those of you who hadn't picked up yet, that was the Queen.
Yes, what an incredible experience, and the pictures are wonderful. Did you have to move to the UK
Yeah,
and with your
moved
family?
moved with my family. I was there for 4 years, and that involved meeting with banks and savings banks around the UK, travel to the rest of Europe. So it was a very busy time to bring that word forward. Again, much of that evaporated by 2008 when we had our own issues here. And that kind of segues into the kind of the next section is how we all remember what happened, but I don't think many people out there understand the level of animosity from the public toward the mortgage banking industry. What you see on your screen, that is the MBA annual convention in 2011 and October 2011 at the Hyatt Regency in Chicago. And you had all these groups like Occupy Wall Street and others who were continuing even 3 years later to shine a light on who they felt was the cause of all the grief that had happened. So here we are at the conference looking out the window and seeing protesters protesting our industry for what we had done years before. And you ask anybody who was there, it was very sobering because I'd like to think that all of us in our industry were really intentional on trying to do the right thing.
Yeah.
And yes, we had times that things we thought were right at the time turned out not to be, but I'd like to think that we have done our best to try to correct them.
Yeah.
But that is, again, it's a very sobering picture because we tend to forget that. And we think that, well, eventually things righted, customers were able to refinance eventually, and pretty soon people got out of things. But it was a tough time, and it was really a very unhappy time for many of us in the industry who had to face that. And
Yes.
then we know what happened. Fannie Mae, even at that conference alone, Fannie Mae ended up under investigation. If you go to the next slide, there's an article where they did an audit of Fannie Mae's spending of $600,000 at that event. And this is even after the takeover by the government. And so certainly after that time, those who started going to conferences have no memory of Fannie Mae doing much of anything other than just hosting some meetings, and that was about it. So we can go away from this for a moment and come back later. There's one more picture, but ultimately, the industry grows, it learns, it moves ahead. And the other thing I wanted to mention was the whole offshoring.
Yeah, I
Picture.
wanted to talk to you about that because that was a big event, not only in mortgage banking, but this was what was happening throughout the economy.
So let's first thing make sure we're all talking about the same thing. There's a difference between outsourcing and offshoring. Outsourcing
Correct.
simply means taking over functions for another company has the responsibilities to do. You can do that and do that in their own backyard for that matter. Offshoring doesn't mean outsourcing necessarily. It means a company or an outsourcer taking work and putting it somewhere far offshore. Nearshoring would be like Canada, Mexico, Central America, but offshoring would be going actually overseas. You think about outsourcing and offshoring. Initially, it was just your mess for less. Whatever you have, we'll do it cheaper here using cheaper people. Over time, that changed as these young people with engineering degrees who tended to be the ones doing the work ended up creating a lot of Six Sigma improvement and actually improving processes and bringing real financial and analytical experience to managing the support. So the company Genpact that I was with at the time offered loan origination support. And so we would take on the origination, the actual origination, the very front end, not fulfillment, but the actual contact with the customers. And then in 2011, September 2011 was a major point in the curing of, or the attempt to cure some of what had happened before with the creation of those alphabet soup programs like HARP and TARP and others. Some of you may remember those.
Yes.
Well, for the first time, if you were a borrower who was paying your loan on time, but your loan amount was greater than the appraisal amount on the house, you could now refinance your loan to lower the rate. And we had one of the biggest explosions of refinances ever. People were on hold for 1 to 2 hours. And one of the reasons, at the same time, you had the NMLS program, which had been created a few years earlier, but was just finally, the states had gone along with it and were coming up with the training. There weren't that many licensed loan officers. And remember, the new rules, you couldn't take a loan application or discuss interest rates with someone unless you had that NMLS license.
Yeah.
So it caused massive backlogs. So one of the projects I worked on at that time for one of the top 5 lenders, we created an origination operation in the Philippines, in our office in the Philippines. And I flew back and forth for a while getting that set up. And what we did, it was all based on the idea that there are 6 elements to a loan application. And once you ask those 6 questions, you now have a legal loan application. You have 3 business days to get the loan estimate out. All of the disclosure requirements that happen on you asking that 6th question. So we set up a call center. So we would get, remember, again, call center. There were no apps. There was no online ability. It was, you picked up the phone and you called and said, I want to refinance my loan. That was the only way in, other than walking in the door of one of the branches of this particular bank. So we set it up so when people called, they got our call center. We set up a system that would ask 5 of the 6 questions. And then the agent would make sure that the person really wanted a mortgage. They weren't just looking for the address to send their credit card payment to. So you now have this pre-qualified borrower, and you have 5 out of the 6 elements of the application information, and they would do a warm transfer to a licensed loan officer at the bank in the US. And what they would get was a pre-qualified, ready-to-go customer that they could then collect the rest of the information, discuss interest rates, finalize the loan application, send out disclosures, and move on. It was really successful because it cut hold time down to very little, very short. And of course, the loan officers loved it because they were only talking to qualified customers. And that lasted for almost maybe a year and 4 months or so before the lenders had been able to restaff, because they'd lost all those people back after 2008, restaff their back office, train enough loan officers to where they could take that in-house then. But it was another example of the mortgage industry adapting to the needs caused by a challenge that we found in the industry.
And also, I would say that another example of how interconnected we are with the rest of the world, when things were so tight and were changing so fast, that offshoring mechanism and strategy was paying dividends for you and for your company, that your clients that you were working with.
And now it's just a given. And this morning I taught a School of Mortgage Banking virtual class, and there were several people in the class from India, from one lender's operation there. So it's just now become more accepted. Of course, in the era of AI, all bets are off.
Yeah.
And that becomes more of a, what's the future going to look like? And it may take all the movements of offshoring, and it could bring it back here.
Going for a moment back to your time in London, in the UK, I wanted to ask you, how did your time abroad change your view of the American mortgage industry when you came back?
Right.
Was there anything that you brought back from the UK?
I had never thought about the mortgage industry outside the US, and all I knew was the way we do things here. And one thing I realized very quickly, because they didn't have 30-year fixed rate, 30-year amortization mortgages. They would have 25-year amortization, maybe 5-year fixed mortgages. So the people in the UK, this is at the time, I mean, while I was there, were very fluent on their mortgages. You ask the average non-financial industry person now, who's your loan with? What's the interest rate? What's the average rate today? And if you had to refinance, where would you go? It'd be tough to imagine you'd get an answer from many people. But over there, everybody, receptionists, it didn't matter. They had this knowledge. And what would happen is, because they were such short term, it became conversational knowledge to see who has the best rate. And remember how easy the documentation, much easier than now. Borrowers would jump from one lender to another very quickly. There was a term which was considered rather rude. It's not in the US, so I'm going to say it anyway. But in the UK, it's a rude expression. Lenders would refer to them as rate tarts, which meant people that were kind of, were always jumping for a lower rate. And I didn't understand. I saw the reaction, but I didn't understand it because at that time I didn't speak British English as well as I did after a while. But what I realized, and here's the core difference, I think, between the US mortgage market and other mortgage markets. We create products, and then we look for customers to buy those products. Those products are standardized. They have common underwriting. They are done in a way so that we can get data on millions of transactions from many, many mortgages that are comparable so that we can make better decisions and have a much more efficient market, lower costs for customers. And in our view, that's the best way to go. In the UK and other markets, they would create customers and then create the product that was ideal for that customer, which in theory sounded great, but when you went to securitize a portfolio with more than 2,000 distinct types of mortgages, you kind of go, well, this isn't going to follow the same path. So while there was a much stronger element on the customer service aspect, we Americans feel that we're actually doing customers a better service by giving them, it's a question I asked earlier, 20, 30, 40 choices and coming up with the one that will serve their best interest. You have a military background, little down payment, VA loan. First-time home buyer, look at an FHA loan. You're going to live in the house only for a couple of years. An ARM is probably better than a fixed rate loan. Yeah. Remember, we have the legal requirement from Dodd-Frank to give the customer the loan which is in their best interest. And we do that, and this is where QM, qualified mortgages, come in so importantly, by sticking to a very strict set of guidelines, which then allow us to give that customer what they will see as the best product for them with all of the disclosures we had. Now, there's an active non-QM market, which, while still acceptable, perfectly good loans, make sure that we're also serving the needs of customers that have maybe a different credit profile or otherwise are willing to, where the lender's willing to take the additional risk, but still serve the needs of those customers. And you see it today with Fannie Mae, for example, coming up with the calculator for self-employed borrowers and other things that you see being introduced in the market to try to find those pockets of customers that we tend to overlook or not handle as well and improve the processes. It's all about process improvement. That's what but I came back with the idea that, there should be a balance. There should be a way that we can actually design products that really do fit a customer's particular need and still be able to find some efficiencies in there as well. So that was very eye-opening. And the whole idea of what we can do. And I still think there's a place for us to think globally. Our young people that are coming into this industry have no idea of borders anymore. They have friends in other countries through social media. And I think we have the idea, another opportunity, and do it right this time, to be able to provide services that benefit the U.S. homeowner by taking advantage of capabilities around the world.
Very well said. And with all your travels and changes of jobs over these 43 years, I think one of the constant things about your journey has been your involvement with the MBA, especially as an instructor at the School of Mortgage Banking, and this amazing award that you got, the Faculty Fellow Award winner. So you really are dedicated to education in our industry. And I wanted to ask you, what drives you to teach the next generation, and how does the next generation look like? Where are they coming from in
You can
school of
show the
mortgage
next
banking?
picture while I'm answering that. You can show the next picture if you want.
Mm-hmm.
I'll tell you something. First thing, I've always been a big believer in the MBA as a means to help our industry be successful. And here, the School of Mortgage Banking has just a phenomenal way to first thing introduce young people to the industry, to give people that have been around a while a chance for a refresh, to establish relationships. People I know from years, decades ago, will find you at a conference and remember you from a School of Mortgage Banking class. Those interactions are so important. I tell the people in the class that they'll get a list of the people that their fellow students, and you might have a VP of underwriting, and that person can become a contact later when you have a question that you want to ask. But it does give a good grounding, particularly the second and third School of Mortgage Banking 2 and 3, in how our business operates at a technical level. I think our industry has benefited too, because individual lenders don't have to provide that level of education about the wider business. It's a service that can be provided by the MBA, and it's something that is, I've been teaching School of Mortgage Banking since the mid 1990s, on and off, and it's even though I'm semi-retired now, it's something I'm glad I'm able to continue doing, and look forward to meeting. And every new generation brings its own skills, its own capabilities. Those of you, by the way, if you know the IRLA, the Uniform Loan Application,
Yeah.
the new loan application, and if you know what Section 8 is, and if you do, you'll know exactly where I'm headed. That's a section of the loan application which requires, as a lender, you have to ascertain the gender, ethnicity, and race of the borrower if they don't want to self-declare it. And you can see with the younger people who have grown up in an idea where you just don't ask questions like that, it's a bit of a shock, and it takes some explaining that we've had so many bad sort of judgments in our past. This is a way of holding ourselves accountable to ensure that we do the right thing by reporting this information. It's not a means for discrimination. It's the opposite. It's a way to ensure that lenders are in fact making loan decisions based on someone's ability to repay and not based on these other factors. But it is something to get people in a room and see them react to something like that, where it seems to go so much against what they've been brought up to believe.
Yeah, yeah. And that information from ERLA goes into the HMDA reporting. Then HMDA users like me, data users, we model it, and then it becomes a means for mortgage marketers to create better products, to ensure that they're covering, that there is a fit between the product that they're offering and the market, the community that they're serving. So it has, I think that data is incredible and definitely should never be used for bad
Right.
things or to discriminate or any of that. It should be always used for good, to lift us all up.
I would love to see the day where you don't have to sign 25 documents to close a loan. But so many of those disclosures and other documents are there to make sure we don't make the mistakes that we did as an industry in the past. And I wouldn't say mistakes. I'd say we had a belief that something was going to work well a certain way. It didn't. And once again, as an industry, I really think we've done a really good job at learning from the mistakes we've made, putting protections in to ensure we don't do that again, and updating our view as what's ethical in our industry and be sure we stay at those highest standards.
Yeah. So we are coming to the end of our interview, and I want to express my sincere appreciation, Mike, that you've taken us on this incredible journey. We went to the UK, we saw the Queen in your pictures. We understood the global nature of the mortgage industry. Some of the concepts were applying, some were not. I think this was, for me, certainly this was like traveling with a time machine back to early 80s and back to today, 2025, as we are recording this podcast. What do you think, what is the next fundamental evolution for the mortgage banking industry for the US that you see on the horizon from this perspective that you have, the 43 years in the industry?
At the core will always be the customer who wants to buy a home or wants to reduce the cost of the home they already own. We will find ways to do that so we balance better. We're still not quite there yet. We'll balance better the need for that customer to make an informed decision and making the process easy to manage. Artificial intelligence is the latest in a series of things that we think is going to blow up the industry. It will to an extent. I've always believed in two things. When things are going really well, they will get worse. And when things are going really badly, they will get better. And so my message to particularly people who do better in the good times is save some of what you make because you'll need it later. We will be in reactive mode as we have. I'm of the belief that the environment of artificial intelligence, not the thing itself, but the environment that it's going to produce will have many more people with analytical skill sets in our industry. Not rather than just say sales ability, it'll become more important to be able to make more descriptive decisions. I met some people from one of the banks in South Korea while I was in the UK, and I asked, they wanted to talk to me about how to improve their processes. And I asked them, well, how long does it take you? What are you looking to do? They said, we want to cut the time it takes to close a loan by 25%. It's admirable. How long does it take today? 4 days. They wanted to cut it to 3 days. And I was just thinking, I'm not the right one to talk to about this, certainly at the time. But we could get there in a way where time constricts and we're able to do some of the things that some of our more nimble foreign neighbors are able to do because of the flexibility they bring with other products. So ultimately, I see us in a position of starting to affect the customer in their whole holistic financial profile, where the examples I gave earlier, using insurance, using combining accounts, balancing other credit needs, the ability for the first time to undo this closed credit mentality we have and allow people to borrow back funds on the loans that they already have started to pay down. And if we can achieve that, we will continue to be out in front of providing quality and meaningful solutions for our customers.
I love that vision. And as a data scientist and mortgage banker, I totally agree. We'll see more of the analytics changing our industry, and hopefully for the better, for the win-win for the lenders and as well as the borrowers. And as the industry changes, how must our designation, the certified mortgage banker designation, evolve to continue to prove its value as the gold standard for expertise, for knowledge, for ethics?
When someone told me when I got my CMB that this would be not an end of my career, but a touch point that would add kerosene to the fire, I didn't really see what that meant. And now it's been 30 years, I'm still here. And I would say to those who have it, who got it recently, or those thinking about it, it is a call to action and a commitment on your part to bring excellence beyond your own capabilities, to continue to learn, to continue to innovate. We always said, you are a team of spokespeople for the mortgage industry and for housing finance. And at any point in time, somebody may, in those old days, if a reporter wanted to talk to somebody in a particular market, they would look up the list of CMBs, find somebody local and give that name. So there's a need, one, ethical standards, to be able to have a meaningful conversation, whether it's with another lender, a borrower, or a journalist, on what's actually going on in the housing finance industry. What are the challenges and what are the opportunities? To talk to a politician. That's why that national advocacy concert is so important to attend if you can get there, to be able to talk to the legislators who make the rules that we then have to follow. And there's an opportunity to get out in front of that. And that CMB designation gives you the credibility and the motivation to want to not just achieve that excellence, but to play an integral part in moving our industry forward in ways that we can't even envision now. And the last thing I'll say, Val, we have spent a lot of time fixing things we did in the past. What I'm most fascinated, if I could have a crystal ball and ask it one question, I'd love to know 10 years from now, what are we doing today that we decide years from now was not the right thing to do? Because there's always been a point in time in the past that we look back and say, "Ooh, we need to fix that." And I look at where we are as an industry and think, okay, what's going on now that might need to be, I don't know, I have no idea. But somebody watching this video in 2035, can look back and laugh and say, boy, they had no idea, did they?
That's right. That's right. Well, Mike, this is really a thought-provoking question and a perfect note to end our conversation today, which will continue in the CMB Society afterwards. But for the podcast, it was a real gift to have your time and your wisdom, the sharing of those stories. True gift for all the listeners to the podcast. And I can't thank you enough for taking us on this journey throughout your career that coincides with the most important milestones in our industry. I feel like I was in a time machine today.
And I feel old, but thank you for that.
No, you're not. And I want to congratulate you one more time for the 30th anniversary of your CMB and just being such a powerful presence with us. And to relate to one of your photos, royalty. You are a CMB royalty.
Thank you, Val. It's been a pleasure.
For our listeners who were inspired by our conversation with you today, where would you say that it's the best place for them to find you, to connect with you?
Just search for me on LinkedIn, Mike Hyman, CMB. It's probably the easiest way to find me.
Yeah, that's great. I'll drop your handle in the notes afterwards. And to everyone listening, if you enjoyed this deep dive into the mortgage industry, please make sure to subscribe to CMB Connect and follow us. I'm your host, Val Buras, and this is the CMB Connect podcast, where we go behind the designation.